the shares are worthless if
Right.
I'm not there.
The world has become a lot more
Yeah,
complex.
every year, you leave $100,000 inside a company, the government's going to come along and say, "Oh, look, there's $100,000 there. I want 15 of it, just for nothing." And so we take that money and we just move it over here where the government can't get at it.
Nobody wants
Slowly.
to die, Lauren.
Well, you got to.
We're all gonna live forever.
There's there's that, and that's just delusional. Everybody dies.
Well, but
Get
we're
over
all delusional in the same way.
it. That's just delusional. Everybody dies. Get over it.
So we're going to get started with the story of the day. And this is a true story based on a previous client and, obviously paraphrasing a few little things. But Lauren, I look forward to hearing all of your thoughts about this story, this business case. All right. As the owner of a generational family farm, I've always been proud of our old school values and family first culture. My grandparents started the farm and it's been passed down to my father and now to me, and I hope to my son in the future. We've faced many challenges over the years, but our commitment to keeping the farm in the family has never wavered. However, as I look to the future, I'm concerned we're not preparing like we need to be. I'd like to retire in the next 5 years, and the world has gotten so much more complicated. When we bought the farm from my dad almost 30 years ago, it was a much simpler time. I don't know what I don't know what I don't know, and I've been resistant to change and putting together the necessary checks and balances, such as insurance, legal documents, and policies. We've always operated on trust and mutual understanding, but I also know the world's changing and we need to adapt. And the last thing I want is for us to have to sell the farm. So enter Lauren Shale. Thank you for coming on the podcast, Lauren. Lauren's a
Sorry.
financial planner and trusted advisor.
Just listening to you talk. I'm like, am I supposed to say something now?
You say something whenever you want to say something. So enter Lauren Shale, a financial planner and trusted advisor. Lauren has a relational approach that we think would really support clients with this particular challenge. With his background, with your background, Lauren, growing up on a small farm and your focus on eliminating debt, building wealth, and leaving legacy, I think you might be the perfect person to help us navigate with these challenges. So, before we get started, welcome to the show.
Thanks for having me.
Fabulous. Tell me what makes you a great person to help with this kind of challenge.
There's a lot going on, and as you mentioned, I grew up on a small. It was more of a hobby farm. It wasn't really an actual operating business farm. My father was actually a corporate executive, and he moved to this. We bought this farm. He grew up on a generational family farm in the 1940s and
Mhm.
50s, and by the late 70s, he was starting to feel the itch a little, and so we bought a small farm outside of town, and basically played gentleman farmer on the weekends while he was being the corporate executive in the city during the week.
I
Uh,
adore that. Just so you know, I
but
totally adore that.
yeah, it was fun. It was an interesting dichotomy of his of the way we ended up living because um, well, I won't get into a whole lot of detail about that, but we kind of grew up. The location itself was just kind of out on the outskirts of town,
Mm.
not too far from a fairly large city, um, and so the relationship and the dynamics of the town itself and the people that we interacted with was very diverse. There was a number of family farm in the area. It was a big dairy farming area, as well as the townies, as you want to call them.
Yep,
And
I'm one of those.
so that was kind of the environment that I grew up in.
Mhm.
And I got into this business after having spent 20 years almost as a marketing executive in the Canadian music industry,
Okay.
working with creative individuals, musicians, and so on. And I learned a lot um, about small business essentially,
Mm.
and even what I refer to as micro business, which
Mhm.
would be one and two people operations that are almost cottage industry-ish in a way, but that can grow to be extremely large operations from a financial standpoint,
Mhm.
but still operate with kind of on a shoestring of just a few people. And farms tend to do that. It's one family basically running this operation, but it could be a multi-million-dollar operation. Uh,
Mhm.
and you don't necessarily see that or notice that until you do a little bit of digging. Uh,
Right.
so that's kind of how I come at this. Uh, that it's a very simple structure. Uh, Mom, dad, couple of kids, all working on the farm. Maybe one or two neighbors who are employed part time or full time or whatever. Um, but but they're running a multi-million-dollar operation, and
Mhm.
shoestring of personnel, and that's what you see in
Mhm.
a lot of the farms, especially the dairy operations. They can be hugely profitable enterprises with
Mhm.
5 people.
Interesting. Okay. So, you know, it's so hard, right? Because I feel like sometimes the farmers are this like last bastion of the handshake agreement,
Yes,
you know, in a lot of ways, or the small town entrepreneurs, and I'm
absolutely.
from a small town, so I work with a lot of them. I worked with a few people in similar scenarios as this as well, in a totally different capacity than you do. And it's like I feel like that's almost like what we're missing in the rest of the world, but at the same time, we need to like help them have some of the tools to make sure that
Yeah,
because they're not wrong. The world has become a lot more
yeah.
complex.
I was just going to say, you mentioned that in the story,
Yeah.
in the discussion or the story there that you launched this with, that the world has changed. The world has changed significantly, and in preparation for this, I did a little bit of research yesterday, just kind of boned up on some statistics, and
Mm.
one of the statistics that jumped out at me was that less than 8%
Mm.
of family farms have a written succession plan,
Hmm. Yeah.
and that's, I mean, it doesn't have to be complicated.
Hmm.
It can be as simple as son A purchases asset B from father. I guess he would be A, but yeah,
I know what you're
and
saying.
and it doesn't have to be a 60-page legal document. It just needs to be something that's written down that everybody involved understands.
Yeah,
And so that when the time comes, there's no confusion and there's no indigestion at family Thanksgiving dinner.
totally. Yeah. Where does insurance come into play here? This is really your bread and butter, right? Is the insurance industry?
Yeah. Let's back it up a little bit first.
Sure. Let's back it up.
Um, when we start talking about succession planning in a family business,
Yeah.
there's well, a number of factors that need to be brought to the table. And then first one is that a family farm is
Mm.
treated differently by CRA than any other business. So one of the first things that you need to understand when you start talking about succession planning in a business like this is how the CRA is
Right.
going to treat the sale.
Hmm.
And without getting super technical, everybody understands or everybody has heard the term capital gains.
Mm-hmm.
So under Canadian law, under CRA rules, the capital gains tax is charged. The definition of capital gains is
Yeah.
essentially the value that an asset has increased, the amount that an asset has increased in value
Mm-hmm.
since from the time you bought it. So there's two numbers that come into play. There's the purchase price,
Mm-hmm.
which is referred to technically as the adjusted cost base, and the sale price,
Mm-hmm.
which is the and then the difference.
Mm-hmm.
Now, oftentimes what people will say is, well, what if I bought the business from grandpa for $1?
Mm-hmm.
The CRA doesn't accept that as the sale price. The CRA says the sale price is actually fair market value.
Right.
So if the assets are gifted to you,
Mm-hmm.
the CRA doesn't care. Like,
No.
the assets were actually this, and whether you paid that money or not, that's what we're going to calculate taxes on. So that's the first thing that people need to understand is that when you're transferring assets between family members, between or a close friend or whoever, if you don't sell it to them for fair market value, you're
Mm-hmm.
still going to pay the taxes
Yep.
at fair market value.
Mm.
Um, the other thing to recognize is, and the conversation comes up all the time, is that under the CRA there is what's called the um, the capital gains tax inclusion rate. And
Mm-hmm.
for a Canadian controlled corporation, the first $1 million and change of of share value
Mm-hmm.
is exempt from capital gains. So this comes into play a lot with small businesses where I will be having this conversation, and the business is worth, it's a small business, maybe it's worth $500,000 or $1 or $2 million, and they're like, well, we don't need to do any tax planning because we're not going to pay any tax on it anyway because of
Oh,
this
okay.
tax inclusion, which technically is true only under certain specific circumstances.
Mm-hmm.
The way the law is written, it says that the first $1 million in change, it's actually 1,016,000, whatever. And it changes every year, goes up every year. The way the law is written, it basically says that this first $1 million of share value
Mm-hmm.
is exempt.
Mm-hmm.
So that means, number one, it has to be a corporation.
Mm-hmm.
You don't have shares in sole proprietorships.
Right.
So if you're not incorporated, there's no capital gains inclusion rate. There's no, or rather, there's no capital gains exclusion.
Mm-hmm.
Everything is considered a capital gain. So if you're a mom and pop shop that didn't incorporate, if you're a partnership that didn't incorporate,
Mm-hmm.
this whole idea of the first $1 million is exempt from capital gains is false, because
Right.
it has to be incorporated.
Mm-hmm.
The other thing that people overlook or don't realize is that a lot of these small companies, and again, I work with very small companies.
Mm-hmm.
A lot of these small companies, their greatest asset is actually the people who work there.
For sure.
So if
Yeah.
I'm selling my business and I'm essentially the business,
Yeah.
then the shares are worthless if
Right.
I'm not there.
Yeah.
So then what ends up happening is you're not selling your company for shares, you're selling the assets of the company and then winding down the corporation.
Right. Yep.
And the asset sale, if I'm selling a truck or
Mm-hmm.
inventory or a contract,
Mm-hmm.
um, service contract, whatever, that can't be brought into the capital gains inclusion rate either, because it's
Mm-hmm.
not share in the company.
Of course. Yeah. That makes
So,
a lot of
so
sense.
these are the little stipulations that inside the CRA rules that people who are especially small business operators really need to understand.
Yeah.
And I mean, I'm not an accountant, so I can't give you actually accounting advice. This is just
Mm-hmm.
situations that I've seen over the years. Now, translate that back to farm businesses.
Mm-hmm.
The CRA has basically said that farm businesses, because of their nature, it being a family operation a lot of the time, don't have to be incorporated.
Mm-hmm. Mm-hmm.
But because of most of the asset in a farm property is actually in the land.
Mm-hmm.
This is now the land transfer that's happening. That can be done between family members without having a corporation.
Mm-hmm.
A lot easier if you are an incorporation, but you don't have to be. And then the other thing that the discussion that ends up happening is, okay, then we go back to that same scenario of, okay, I don't really need to do a lot of tax planning because I'm only going to sell the business to my son for $1 million or $1.5 million. Then you have the discussion of, okay, well, wait a minute, fair market value.
Mm-hmm.
And you also have the discussion of, um, if that's what you're doing, junior might not have the credit
Oh
to
yeah.
go to the bank and fund the taxes that are coming due, because it's, as I said earlier,
Mm-hmm.
a lot of these farm operations, you look at them, you drive by them on the highway, and you're like, yeah, that's $1 million operation, that's $1 million operation. No, that's a $10 million operation, and you don't even realize it.
Yeah. It's
It
deceiving.
doesn't take long. You got
Mm-hmm.
100 acres of land. You got
Yeah.
you're putting out. I grew up in, as I said earlier, I grew up in dairy and corn country.
Mm-hmm.
So you got 100 acres of land. You're cranking out, a couple of 100,000 bushels of corn a year. Um, you got 200 head of cattle,
Yeah.
and those dairy cows are producing are attached to a production contract with the marketing board, and you got a $10 million operation.
For sure. Yeah.
And Junior isn't going to have the credit to,
No.
to buy that from dad.
And that's that's where we kind of intersect, right? Because
Yeah,
my job is to help senior let go and
yeah,
and figure out how to get junior to
right.
start leading and to know what they need so that in 5 years, you can't do this in a year or even 2 years a lot of the time. Sometimes it takes junior 5 years, to get ready to have the to
Yeah.
not just the capital, but the credit to be able to take this on, right? And to
So
have the skills to
oftentimes,
take this on.
what ends up happening, or in my experience at any rate, and maybe you can speak to this too, but oftentimes what ends up happening is we'll take the example of my friend David, who
Okay.
I went to high school with this guy, a dairy operation, Southern Ontario, where I grew up, who went to university and did the agribusiness courses and everything else. At 24 years old, comes
Mhm.
back home, and and dad creates a partnership with Junior,
Yeah.
and dad slowly steps away, and Junior slowly
Yeah.
buys the shares out. It takes like 25 years to do that,
It can take a
because
while.
there was no way he was going to be able to come up with a loan
Mhm.
for the million or $3 that the CRA was going to demand
Sure.
to make that transfer. So now
Yeah.
they can do it over time.
Yeah.
So that's the kind of one of the first things that I would say in a situation like we discussed earlier is yes, okay, you want 5 years, but really, how much time do you need?
Mm.
Because if senior is 60 and he wants to
Mm.
retire at 65, that's one thing.
Mm-hmm.
But if he's going to kick around and dabble,
Yeah.
buy and drive a tractor once in a while for the sake of driving a tractor, then maybe we've got 25 years to do this.
Sure. Yeah. Every single scenario is different. Yeah.
My another situation,
Mhm.
I knew of where they did something similar to this, and senior, again, a second generation senior, so this was like a 3 generation family farm, but senior was 85 years old and still going out and cutting hay and doing whatever else, just because he wanted to be there.
So this brings me to I mean, maybe we're everything, all roads lead to insurance, but I mean, you always hope you're going to have another 25 years when you're 6 years
Absolutely.
old.
Yeah.
But what if you don't?
Right. So then, yeah, you're right. All roads tend to lead to insurance in one way or
Mhm.
another. There's a couple of things when we get into succession planning too that we have to understand about the family dynamic.
Yeah.
Uh, and we get into what I call estate equalization.
Mm,
Because if there's two or three juniors
mm,
and only one of them wants to take over the business, we got to figure out a way to treat the other two fairly.
right.
And so that's when we get into family trust structures
Mm-hmm.
and funding certain things with life insurance. And,
Mm-hmm.
and also where we talk about how do we make Thanksgiving dinner go smoothly
Yeah.
without having some of the children feel like they've been shafted.
Sure.
Because again, we've got a $10 million operation here,
Mm-hmm.
and one son took over the business,
Yes.
and so now he's managing and controlling this massive asset.
Mm-hmm.
These other two kids are left to kind of go out and make life on their own, um, without the benefit of this functioning business.
Mm-hmm.
So, I recommend in situations like that, what I call an insured asset transfer process, which
Okay.
is where we take a life insurance policy that
Mm-hmm.
is funded by the proceeds of the business,
Mm-hmm.
and that life insurance policy now is designed to do three things. It's designed to offset some of the taxes that would come due if senior died suddenly, and
Mm-hmm.
complete that transfer quickly.
Yeah.
Um, we would have the life insurance policy there to do that, but it's also there to provide um, the other beneficiaries with
Mm-hmm.
enough money that they feel like they've been treated fairly.
Right.
Um, so in a case like that, we've got a again. I keep coming back to the value of the operation, but we've got a $10 million operation. We've got one son that's running the operation. I know we've got two other kids that are sitting there going, I need or I should receive
Mm-hmm.
$3-4 million from my trouble. And so we can set that up as an estate utilization approach through a family trust or through a well-funded and well-designed life insurance policy.
Right. Yeah. And this is why partnering with people like you, Lauren, is so important.
Yeah.
I think. Yeah, you've got a lot of insight under your belt there, and you've been through a lot of these scenarios. So, I think you're a trusted advisor for a lot of people, for sure. Yeah. So, if you are in this scenario, you're working with a client in this scenario, and I mean, there's a resistance, there's a palpable emotional resistance to this kind of structure in a lot of cases. The folks that I've worked with, it's been, it's a process of kind of getting to that point where they're comfortable having a conversation with you or someone like you, right? And that's part of my job is to get them there. But what would you say to someone who's in that scenario, who's a little bit resistant?
Well, we got to figure out what they're resistant to. Um, and there are some misconceptions in the world about what life insurance is for.
Mm-hmm.
And there are some issues people don't quite understand about the the tax treatment of things.
Mm-hmm.
And so the number one thing that people need to understand when we start talking about life insurance, the number one thing I think people need to understand is that it is essentially a tax-free asset.
Mm-hmm.
Um, the proceeds of life insurance pay out tax-free.
Mm-hmm.
And again, depending on how you structure it, that is a very valuable piece of information for a lot of people.
Mm-hmm.
So, um, not just in farm corporations, but again, if we go back to the other corporate structures that I mentioned earlier, If you're sitting on a company that has a couple of $100,000 or so of retained earnings
Mhm.
just sitting inside the company, everybody knows that to get that out, you got to pay dividend tax.
Of course.
But
Yep.
if the but if instead you use the money inside the company to pay life insurance premium, you're transferring the asset from a taxable environment to a non-taxable environment, or a tax deferred environment.
Mhm.
So now as it sits, that money sits when money sits inside a corporation, it attracts tax, just the regular corporate tax rate stuff, just as it sits there.
Mhm.
If you use that money to purchase a life insurance policy, that tax stops. That passive tax as it grows has stopped because the money has technically been spent. You
Mhm.
can't write it off as an expense, but but it's no longer just a passive growth that's happened. So
Right.
that tax has been stopped. And then when the individual dies, the owner of the company dies, the company receives the proceeds of the life insurance policy tax free,
Mhm.
and it can be paid out to the heirs
Mhm.
of the corporate owner through what's called a tax capital dividend account, the
Mhm.
notional account that's created on death by CRA, which is again a tax-free account.
Mhm.
So now all of this money has come out of the corporation tax-free without having to be paid on it, without having any dividends charged on it or anything like that.
Mhm.
So that's a structure that we use all the time for all corporations, whether it's a farm corporation or not. But it works within a farm corporation, obviously, just as well as anything else.
Well, that's a good angle because I think every single one of my small bit, certainly the farm clients, the generational family businesses, got something in common. None of them like tax.
Right. Yeah. So
Yeah.
essentially, the way I explain this to people all the time is when we put a life insurance policy inside a corporation,
Yeah.
what we've essentially done is we've moved money that's from one pile that the government is taxing
Mm-hmm.
every year. You leave $100,000 inside a company, the government's going to come along and say, "Oh, look, there's $100,000 there. I want 15 of it."
For sure. Mm-hmm.
Just for nothing. And so we take that money and we just move it over here where the government can't get at it.
Mm-hmm.
And it sits there and it grows, it does its thing because life insurance policies grow with dividends and everything else, and it grows tax deferred. Government can't get at that money while it's in life insurance policy.
Right.
Then when Buddy dies, the cash drops into the company
Mm-hmm.
and gets dividended out
Mm-hmm.
to the heirs of the company through this CDA
Mm-hmm.
that is tax free. So we've moved money from a taxable environment to a non-taxable environment.
Mm-hmm.
Whereas if we just left the money in there and as it grew and the government grabbed their growth tax every year, so they're taxing money off of this. And then when you try and dividend it out, they're going to take tax on it again,
Mm-hmm.
dividend tax. It's the only time
Mm-hmm.
in Canadian tax law and just about any Western world tax law where the same dollar is taxed twice.
Yeah. Mm. Wow. That's definitely an angle that'll attract some of these folks, I think. And knowledge is power, right? I think you'd probably agree. Knowledge is power.
And
Um,
the other thing is like life insurance companies, life insurance gets a bad rap
mhm.
because there's always
Nobody wants
stories
to
of,
die, Lauren.
well, you gotta,
We're all gonna live forever.
there's there's that, and that's just delusional. Everybody dies.
Well, but
Get
we're
over
all
it.
delusional in the same way.
That's just delusional. Everybody dies. Get over it. No, the point is though that we've all heard the horror stories of somebody who paid into this life insurance policy for years and years and years and then never got paid.
Oh,
But but they're almost what I refer to as as the urban legend because
mm,
everybody talks about this stuff and they think about it and they're like, oh, I heard about Buddy, and I'm like, okay, who was it? Where did he live? What was his name?
right.
How long ago was that?
Mm,
They don't have the specifics because it actually never happens.
probably not. No,
No, it's
I haven't
it's
heard of that before, for the record. So
what's that?
I haven't heard of that for the record. I'm just gonna live forever. That's my. Just
Right.
kidding.
There you go. There you go. Now the I don't want to gloss over this, and I
Yeah.
meant to bring it up. I meant to bring it up sooner. Is that there's also a thing a relatively new thing in life insurance.
Okay.
Um, that's critical illness insurance.
Okay.
It's basically living. It's basically as one of my friends put it, um, it's insurance for the unsuccessful heart attack.
Hmm. Yeah.
So
There's been a lot of those.
yeah, what's a successful heart attack? It's one
We're
that's been
getting really good at, bringing people back to life after these things.
we're getting really good
Yeah.
at unsuccessful heart attacks and unsuccessful cancer
Yeah.
and
Totally.
unsuccessful, so these are things that if you get it, you
Hmm.
don't die,
Hmm.
but your life is altered.
For sure.
So so we have so we now have what we call critical illness insurance,
Hmm.
which pays out upon diagnosis of one of these major illnesses,
Hmm.
so long as you survive 30 days. And
Fair.
because if you die before 30 days, it's just life insurance.
Sure. Yeah.
But if you have a heart attack and survive,
Hmm.
but you can't work the farm the same way you used to,
Hmm.
nice to get a little bit of money
For sure.
to
Yeah.
kind of offset your lifestyle, and other things.
Yeah.
Disability insurance is harder to get
Mm.
because it's based more on your income. And if
Hmm.
you're underreporting your income, like a lot of small business owners and farmers do, if
Yeah.
you're under no nobody underreports their income. Come on,
What are you
no.
talking
But
about?
if you're underreporting your income, um,
Yeah, they
the
are.
critical illness insurance policy doesn't care. It's
No.
an insurance policy that pays you $100,000
Mm.
on diagnosis of a heart attack or
Right.
heart disease, then that's what you get. Whereas if you say, I make $100,000 a year and I need a disability insurance policy that's going to continue my income
Hmm.
at that level, now you got to prove that you make that kind of money
Hmm. Hmm.
before the insurance company is going to approve you for that policy.
For sure. Yeah.
So,
We could go into underreporting income too and why that's usually a bad idea. Just for the record, like, but on actually though, if you're trying to grow your business, there's a bit of it's like a double-edged sword, it can be.
right. And
Yeah.
I mean, I don't begrudge anyone that tactic, um,
Mhm.
for a lot of reasons. Um, even corporations, small business corporations, if you want to simply pay yourself dividends
Mhm.
from the growth of the company, which a lot of entrepreneurs do, they just pay
Mhm.
themselves dividends. Then you don't even really have to underreport your income because it's all your income's all in the company,
Mhm.
and you're just taking out what you need to live.
Mhm.
And I've seen that scenario play out a number of times as well,
Yeah.
where we've got a meeting just last week with a gentleman
Mhm.
who has a company, makes probably $2 million a year. He pays himself 60 grand a year
Yeah.
just because that's all he needs, and everything else lives inside the company. And he was in another one of these situations where now he's got all these retained earnings that are attracting all of his tax. So I was like, well, I understand why you don't want to pay yourself a lot of money, but
Mhm.
protect this pile of retained earnings here from
Right.
that man too.
Yeah. Yeah. Well, you're a treasure trove of knowledge, Lauren.
Yeah.
Is there any final words? One of the things I like to ask, at the end of the podcast is if you were in this person's shoes or if this person was your client, what's the one question, the most important question that they ask themselves?
Well, as I said at the start, the story that you laid out, um, is fairly common,
Mhm.
um, but it was also a little bit vague in terms of some specifics. So I would want to know what type of farm we're talking about here specifically,
Mhm.
because there are different approaches and different considerations if we're dealing with a dairy farm that has a big milk quota versus just a straight up cash crop situation. I want to know how many kids there are
Mhm.
for that estate equalization conversation.
Mhm.
And I'd want to know how the transfer, the first generational transfer happened.
Mm.
Because when we're talking about adjusted cost base on the taxes, we want to know how far back we have to go.
Mm.
But I think the number one thing that people need to understand when they're doing succession planning,
Mhm.
regardless of whether it's a farm or other type of business, you got to get your head around capital gains tax,
Mhm.
and how that's going to affect things.
Mhm.
And I'm not an accountant, so you
Right.
need a good accountant
Yeah.
who can help you understand that. And then once you get your head around how the capital gains tax are going to be treated,
Mhm.
then you need to engage someone like myself
Yeah.
who can work on ways to offset or defer that tax for as long as possible.
Mhm. Mhm.
And and the way we do that 9 times out of 10 is with a permanent life insurance policy
Right.
that grabs that asset, shelters it from tax, and
Mhm.
moves it forward.
Okay.
The other piece of information that I didn't get a chance to discuss earlier is that when we're dealing with a permanent life insurance policy, a lot of people will sit back and say, well, I don't get the money until I die. And
Mhm.
that is not true, or not necessarily true.
Okay. Tell me
Um,
more.
the permanent life insurance policy has this cash value component.
Okay.
And the cash value is your asset.
Mhm.
You can withdraw portions of it. You can't withdraw it all because it collapses the whole policy, but you
Mhm.
can withdraw portions of it as it grows and
Mhm.
generate an income that way. You can also use it as collateral for a loan and borrow against it to get
Mhm.
more money.
Right.
And now you've created another expense for yourself in
Mm.
interest. So any interest that's going to be charged when you borrow money against that policy becomes write-offable.
Right.
So you can use that to fund your retirement. If you get a large enough life insurance policy with a big enough cash value, you can
Right.
borrow enough money against it to fund your retirement. And then when you eventually pass away, because everybody dies, I hate to break it to you, but everybody dies. Um, that was my Donald Trump impression. Everybody dies.
You need to do your TED
Um,
talk on everybody dies.
but the point being that
Yeah.
when you eventually die, the life insurance policy pays off the loan, and
Right.
then away you go. Right. So there's
Well.
no residual there. And there
Mhm.
are companies out there, there are banks
Mhm.
out there that structure these deals. They understand how permanent life insurance works, and they structure these deals in such a way that you don't have to repay them while you're living.
Okay. Yep. Makes sense. Not really. But this is why you have Lauren, guys. Don't worry. All good. You're in good hands.
Yeah,
This is why Lauren knows stuff, so we don't have to.
yeah. Well, I mean, the point being, if you borrow against your life insurance policy, and the
You don't worry about it.
and I won't say it about the bank, but if you borrow it right from the life insurance company
Yeah.
themselves, they won't insist on a repayment plan because they know that
Right.
they're going to get their money when you die.
Yeah, that's fair. That makes sense. Yeah, that does. All right. Well, thank you very much, sir. It's been a pleasure and an honor.
I appreciate that. I appreciate the opportunity. Thanks
Absolutely.
for thanks for listening, and I hope I didn't confuse anybody too much. But I'm sure in the show notes you'll have my contact information, so they
We
can
are
call. And
putting your contact information in the show notes and your website. So don't worry, folks, if it made no sense, Lauren knows what he's talking about, and he can guide you through it. You're a good guide. A good
yeah,
guy and a good guide.
there you go. that's it. All right.
Awesome. Don't forget to stay weird, stay wonderful, and don't stay out of trouble.